co-authored the note along with Nandita. But at the end of the day, what does this mean for our portfolios? Will obviously be on top of all of our clients' minds. So we also have Rakshit Ranjan, who's the lead manager for the CCP PMS. We'll also talk about implications for the other strategies as well. So the first half will be talking about the comparison with the 70s, and then we'll talk about our portfolios, and then we'll open it up for Q&A. So feel free to fire away the questions in the Q&A box. We'll try and take as many as we can today. Like we've always maintained, no question is too trivial. So we'll try and do justice to all of your questions out there. So with that, I hand it over to Saurabh. Over to you, Saurabh.
Thank you, Pramod, and thanks to everybody who's logging in on this Friday evening. So one of the reasons we thought we should do this session, right, is over the last 3 or 4 months, we noticed a couple of points of view are increasingly widely believed in our country, right? I won't say they're popular, but they're widely believed. The first point of view, which is widely believed, is that, look, the Federal Reserve is going to hike rates, and that's that's deep trouble for the Indian stock market, and hence, we should, as in those who are watching this webinar, start thinking that we should do market timing around Federal Reserve interest rates, right? So the notion that American rates will go up, bad for India, let's hold off investing. So we thought, that's worth addressing. Is that notion really true? Does it really make any difference that the Federal Reserve will be hiking rates? And should you and I hold off investing in Indian stocks just because the American Central Bank is going to hike aggressively? And the second point of view, which has currency, which has sort of popularity amongst investors, is when interest rates go up, high PE stocks pe pressure aayega. High PE stocks will be peculiarly vulnerable when interest rates go up, and hence, we should be doubly careful about high PE stocks, right? So we thought, rather than us giving you our points of view, why don't we turn to history and turn to episodes, the last such episode of brutal input cost rises, and see what happened to not just the American stock market, or also the world's second largest free market economy, Japan, right? And that comparison is what we'll spend sort of 10 minutes on, because it's very instructive. It'll tell you a lot about, I think, how Japan fared in the 70s. Will tell you a lot about how India will fare in the next decade or so. So why are the 70s such an interesting decade, right? 70s was a decade where oil prices rose tenfold, right? At this juncture, oil prices only doubled in our country, or only doubled globally, and a lot of people are starting to cry. But in the 70s, oil prices rose tenfold. Naturally, therefore, CPI inflation was consistently in double digits through the 70s, through most of the developed world. Naturally, therefore, US 10-year bond yields went up. 1971 to 1981, the US bond yields went up non-stop. And it was a tough decade for America. The country went in and out of recession. The stock market gave zero returns, right? The stock market gave zero returns in America in the 70s. Same decade, Japan, the world's third largest economy then. So USA was one, USSR was number 2. Japan was the world's third largest economy then. Japan was an oil importing country, right? And in spite of being an oil importing country, completely dependent on imported oil, the Japanese compound stock market trebled through the decade, right? So 12% compounded. And leading Japanese companies of the sort that all of us know about, Toyota, Nissan, Sony, Casio, they compounded at 20% plus. That was in yen terms. The yen appreciated to the dollar. So the dollar compounding actually was 22-23% from top quality Japanese companies, right? So the American stock market and economy struggling, Japanese economy prospering, Japanese stock market booming, growth in Japan, GDP growth in Japan in the second half of the 70s was a solid 5%, and inflation was under control. You can see all of that in the charts. I see the orange line, which is the American stock market being flat. The dashed blue line is the Japanese stock market trebling, and the oil price are the gray bars. Oil price is going through the roof in the 70s, right? Now, how did this happen? How did Japan pull this off? Right, America's struggling. Why was Japan not struggling? Japan was not struggling because it had built through the 60s and especially through the 70s. It built an economy which was low energy consumptive. They spent a lot of time and effort figuring out how to import less crude oil, and just as importantly, they shifted their industry away from heavy industry. Right, heavy industry uses far more oil, far more energy. They shifted it from heavy industry towards light industry. Right, light industry, cars, electronics is what Japan became famous for. We'll discuss how the Japanese government pulled off that pivot, and the reason we are making this comparison. Right, we're not sort of crazy people who just out of the blue said let's compare India to Japan. The reason we are making this comparison is the Economist magazine. Right, the Economist magazine historically has not been a fan of India. In its 13th May issue, the Economist magazine pronounced that India is already the world's fastest growing large economy, and the Economist magazine opined that it will hold on to that title. India will hold on to the title of being the fastest growing large economy in the world for several years. They've given the reasons. You can read the Economist magazine of 13th May to figure out why India will be the world's fastest growing large economy for several years. We'll discuss some of what they've said in the next 10-15 minutes, right? So that's the summary of what we'll get at. Let's get into the details, right? What happened in the 70s and what can you and I learn from it as we manage money in India. So the first oil shock came in 73, very similar circumstances to today. Arab-Israeli war in that era, not UK and Russia. The Arab countries and Israel went to war in basically over Egypt, and that tripled the price of oil. Then 1979, the Shah of Iran, there was a coup. The Shah of Iran was overthrown. There was a coup. The Ayatollah Khamenei took charge, and the oil price doubled in 79. If you take the 70s as a decade, oil price 10x in 10 years, right? 25% compounding in oil prices, right? Here we try to do stock price compounding at that rate. Oil prices did that, right? And American economy, as I said, severely impacted. The US 10-year bond yield went up for a decade. And you can see on the chart on the left, the hammering for the US economy. So the orange bars are the oil shocks. And basically after every single oil shock, America went into a recession. Degrowth aa gaya. First oil shock in 73, recession the next year. Second oil shock in 79, recession in 1980. America had a really tough time with GDP growth. And if your GDP growth struggles, obviously your stock market will go nowhere, right? And you can see the blue line on the chart on the right. In the chart on the right, the blue line is the US stock market. In fact, the US stock market went nowhere from 1967 to 1983. 0% returns from the US stock market from 1967 to 1983. And as I said, even more shocking, in the chart on the right, see the orange bars. Chart on the right, see the orange bars. That's the US 10-year bond yield. See how it rises non-stop from 1971 to 81, right? Non-stop rise in the US 10-year bond yield from 1971 to 81, right? And I'm giving you this detail so that I set the context. The context is the 70s was a super tough decade. Oil prices, wars, crises, America may recession, 10-year bond yield going up, right? All of that happening. And yet in the 70s, Japan became a super efficient, hyper modern economy. It became an economic superpower, right? How did it do that? How did it do that in these extremely difficult macro circumstances? And how did the economy grow at 5% through the second half of the 70s? Steady inflation, steady interest rates, right? The world on fire, Japan roaring away, right? What did the Japanese do? You can see in the chart on the bottom left, again, we once again put the first oil shock. Japan did go into recession after the first oil shock, like America. First oil shock ke baad mein Japan did go into recession, but look at the second oil shock. Japan just shrugs it off as if nothing's happened. The price of oil more than doubles. Japan powers through the second oil shock. GDP growth, the blue line, the GDP growth, the blue line holds up. CPI inflation also, no problem at all. We've got this under control, see the Japanese, right? And the result is, on the chart on the right, you can see the Japanese stock market roaring away, the blue line, and Japanese interest rates. See how Japanese interest rates fall from 1973 to 1983. Japanese interest rates fall for 10 years. Amazing, right? Absolutely amazing. Oil price going 10x in 10 years. Japanese interest rates falling for 73 to 83, right? So how were they able to do this? The first thing, as I said, was they shifted the nature of the economy. In 1970, Japan had become the world's largest steel producer. Over the next 10 years, steel production barely grew in Japan. Japan basically started handing over that industry to Korea. Similarly, shipbuilding mein Japan had become a world leader by 70. Again, shipbuilding is very energy consumptive. The Japanese vacated that, right? And what did they focus on? They focused on two industries which are knowledge intensive industries, but energy efficient, right? Electronics being the first one, TVs, VCRs, Walkman, calculators, and cars, small fuel efficient cars. These are R&D intensive industry. The Japanese became world leaders in this through the 70s, right? The sort of legend of Japan was really built in that decade of producing world-class cars and world-class electronics at very efficient prices, right? Alongside that, right, they changed their energy consumption. Oil consumption, right? This is just staggering. When we were researching the subject, we found a mind-blowing stat. Crude oil consumption barely grew in Japan through the 70s. Economy growing at 5%, crude oil consumption barely grew in Japan through the 70s, right? One of the reasons was steel production barely grew in the 70s. Electronics production went up 5x in the 70s in Japan, but steel production flatlined, and naturally oil consumption flatlined. Amazing, right? Country growing at 5%, oil consumption flatlining. And you can see another staggering stat. The proportion of Japanese electricity to come from oil fell from 62%, right? 62% of Japanese electricity came from oil in 1975. That 62 became 27% 10 years later, right? Staggering shift in energy patterns. And the third driver of this pivot was funding for Japanese corporates as they powered through the 70s. So Japan then, even now, Japan has a very high savings rate, very similar to India. Household savings rate in Japan was 21-22% in the 70s, still is very high. Our country is around 25%. Both countries have very high household savings rates. And the Japanese banks, admittedly under some pressure from the government, the Japanese banks lent that money to Toyota, Nissan, Sony, etc., so that the capex could take place, right? Our country today, very similar situation, right? Our banks are groaning with funds, very, very strong liability franchise of the banks. I think Tej discussed that in the Kings of Capital webinar earlier this week when we hosted Amitabh Chaudhary ji of Axis Bank. Very similar situation in India, a banking system flush with funds, strong liability franchise. Back to the 70s, Japanese banks lent that money out. Effectively, what happened was the Bank of Japan, the central bank, gave the commercial banks an underwriting guarantee. Bank of Japan said, go and lend the money, commercial banks, I will backstop you, right? I don't know whether the RBI should do that, but anyway, it was spectacularly successful in the 70s. Result was Toyota, Nissan, Honda, Panasonic, Sony, Casio, Kenwood, JVC, all of these companies became world famous. As I said, 20% yen compounding, dollar compounding even better, right? So let's just quickly look at a couple of case studies. The reason, again, we are doing this is to give you a sense of why macro is not destiny, why oil prices, interest rates is not destiny, why the ability of a nation, the ability of efficient companies to understand the world at large, respond intelligently, grab opportunities in markets is what you and I are paying for, right? So Toyota, you might be interested to know, actually was a textile company. I think till the 30s, 40s, they were a textile company. They pivoted to become a car company after the Second World War. So by the 50s, they were already making fuel-efficient, cost-efficient cars. They were the largest car manufacturer, I think, in Japan by the 60s. 70s is when Toyota began their push into America, right? Why did they begin the push into America? Japanese cars were fuel efficient. Even before the 70s, the cost of fuel in America was 2x the cost of fuel in Japan. I'm sorry. Even before the 70s, the cost of fuel in Japan was twice as much as the cost of fuel in America, right? And because fuel was expensive in Japan, Toyota produced fuel-efficient compact cars for the Japanese market. And obviously, as oil prices went 10x up in the 70s, that gave Toyota the market, the opportunity it was looking for. Toyota went into the American market through the 70s. By the end of the 70s, they'd got around a couple of % market share. And by within 20 years, that 2% market share went up to 13% market share. I think today Toyota's market share in America is high teens, right? They're one of the largest players in the US car market. They're the world's largest. Toyota's the world's largest car producer today, right? And here are some Toyota cars. The 50s wala cars, are sort of the purane zamane ka. By the 70s, the cars that Toyota exported to America through the 70s, we've given you some of the pictures down there. They, to be honest, look very similar to the cars we used to see in India in the late 80s, early 90s, right? And the legend of Toyota was built around cars like the Carina, bottom left lime green color. That was what the legend of Toyota was built around, and now it's the world's largest car company. But it all started, that the pivot to export markets took place in the 70s. Another company that many of you will be familiar with, I certainly spent a lot of time on my Casio calculator in the 80s. It was either Casio or my logbook, and I loved my Casio more than I loved my logbook. So this was a kind of Apple type company. It was created as a innovation play. 1957, they created the first electrical calculator. But in that era, there were no semiconductors. So it was an electrical calculator, but an electrical calculator without memory, without semiconductors. It's like a human being without a brain, right? That advance came in the 60s. The semiconductor came in the 60s. Toyota, again, was ahead of everybody. They took their electrical calculator, put memory in it, and created the electronic calculator, right? And then through the 70s, they again exported into America. Alongside Sharp, they became the world's two largest calculator manufacturers. And you can see the evolution, right? The 50s ka calculator is the desk wala construct at the top. Doesn't really look like a calculator, but that was the world's first electrical calculator. 60s is when the semiconductors come in, and 70s, remarkably, as far back as 50 years ago, the calculators look very similar to what they look today, right? Now, these are two examples of companies. Here is a few more. These are the companies which transformed modern Japan, right? We've given you the 5-year CAGR, 75 to 80. 75 to 80, the world is going nowhere. Oil prices are roaring up. These Japanese companies are giving you 20% CAGR. So if you see the average, 20% CAGR. There are a few companies who did struggle. Heavy industrial Japanese companies had a harder time. So Mitsui & Co. was a more heavy industrial company. They had a harder time, 3%. But, familiar names, Citizen, Konica, Fujitsu, Fujifilm, right? You can see them roaring away through the 70s. And if you take the 10-year CAGR into the 80s, where Japan became a powerhouse, the compounding is obviously much more, even more impressive. This is yen compounding. The Japanese yen was 350 to the dollar in the beginning of 70s. By the end of the 70s, they were 250 to the dollar. So if you add the currency appreciation in dollar terms, that would add 2% extra to the compounding, right? Same decade, what happened to America's greatest companies? You can see what's happened here. These are America's greatest companies. These were the superstar companies of the 60s, right? These are the superstar companies of the 60s. And you can see through the 70s, they barely made any money, right? They still outperformed the S&P 500, but 1% compounding doesn't sound much. And these are legendary firms: IBM, McDonald's, Disney, legendary firms. A few pharma names made a little bit of money through the 70s, but by and large, it was a dire time. Even if you take a 15-year CAGR to 87, it was a difficult time for American companies as oil prices and interest rates rose, right? So our contention, right, the Economist contention, our contention is that India stands on the cusp of being able to do a Japan as we get into a very similar decade to the 70s. Cold War type issues, consistent upward pressure on commodity prices, right? If you read the Economist 13th May issue, their core point basically is that on 4 fronts, India has transformed itself in the last 10 years. Read the issue, I'll give you a quick summary. On 4 fronts, India has transformed itself in the last 10 years. Firstly, transport and communication networks are radically better now than they were 10 years ago. 40x growth in broadband, doubling of highway networks, local airline flights, and so on. So radically better transport and communication networks. The second point they make is that energy efficiency, right? India's alternative energy thrust is actually very powerful. We'll discuss it in a minute. The Economist article talks about the solar and hydrogen, the green hydrogen piece. I have to confess, I didn't know as much about it. I went up and read it after reading the Economist piece. So in energy efficiency, the Economist piece says India has made significant improvements in the last decade or so. The third piece they talk about is how the rise of venture capital combined with a more networked economy, how the rise of venture capital is giving India, giving India in the context of the India stack, giving India a whole range of tech facilities that the rest of the world doesn't have. So, for example, America doesn't have Google Pay. Right? America doesn't have UPI. If you go to America, there is no Google Pay, there is no UPI. You use credit cards and purane zamane ka things. In our country, even the auto rickshaw driver that I take from Marcellus to get home says Google Pay pe paisa do, right? So the Economist has obviously picked up on the fact that on a whole bunch of technology features, India has now leapt ahead of advanced countries. And the fourth point the Economist makes is very interesting. They point out that the combination of Jan Dhan Aadhaar Mobile, the JAM piece that Arun Jaitley used to talk about when he was still the FM, right? JAM means that the government is able to pump $50-60 billion of subsidies into the bank accounts of the poorest people without any leakage, right? And the Economist article says that in the last 3 years, basically through the COVID crisis, something like $270 billion has gone into the bank accounts of the poorest people in the country, courtesy JAM, right? So that's their submission. Our submission is India's resilience over the next 4-5 years will arise from three distinct things. Firstly, our macro position is far better than America's. As the American Treasury Secretary and the central bank governor have admitted, they have screwed up in the last 12 months. They have let inflation run too much. America has a massive rate tightening exercise ahead of it. If those of you are watching, you get scared by macro, you will get tons of macro to get scared about in the next couple of years, because America has a mountain to climb in terms of dealing with the inflationary surge that has built up over there. Their interest rates are basically below 1%. Their inflation is 7, right? So the inflation is 8. Their inflation is 8. Interest rates are below 1%. Gap is 7 percentage point gap, huge gap. Our country, the gap is nothing as big. We've got 8% inflation, but our interest rates are 4.5. I think within the next few weeks, it'll become 5. So the gap we have to close between interest rates and inflation is less than half of what the Americans have. So the macro adjustment for America will be far more painful than it will be for us. Secondly, CPI inflation, right? In India, half of it is coming from foods. Half of our CPI basket is food, and government after government, regardless of which political party you have faith in, government after government has used a tried and tested playbook in India to squeeze food price inflation, right? It starts with stuff you've already seen: wheat export ban, sugar export ban. I suspect next up will be rice. And I suspect next up, uske baad will be MSP hikes will be throttled off, right? In parallel, beyond controlling food prices, the government has also banned steel exports. They've also reduced the excise and fuel. Getting CPI inflation under control will be far easier for India than it will be for the Western economies. And finally, the structural changes, right? We've discussed it for years. The Economist article talks about it, right? 40x growth in broadband connections in 10 years, 5x growth in local airline traffic, 4x jump in demat accounts, 3x jump in bank accounts, doubling of highway network, GST, so on and so forth. This is a country transformed, and our work suggests, our research, our contextualization suggests that the next 10 years, India potentially does a Japan. By the way, a lot of people have this, some inferiority complex about India's position. Japan going into 1970 was, as I said, the world's third largest economy, right? USA, USSR, Japan. India is fifth largest. Japan in 1970, manufacturing was 50% of GDP. India today, services is 50% of GDP. Their manufacturing sector was world-class and very competitive. Our services sector is world-class and very competitive, right? And therefore, the analogy, we believe, is appropriate. Now, how will you and I make money from this, right? You're on this call not to listen to macro monologue. You're here to make money. How will we make money, right? it is clear that this chart will play out for many years to come, right? We are creating formal sector jobs at an astonishing rate. If you look at EPFO data, and every month the EPFO data comes out, it's not some hidden data. We are basically creating anywhere between 500,000 to 1 million formal sector jobs every month, right? 500,000 to 1 million formal sector jobs every month. In the last 3 years, we have created 30 million formal sector jobs. The orangey stuff on this chart. This chart is courtesy Kotak Institutional Equities. The orangey stuff is the formal sector job creation, right? We have created 30 million in 3 years. The entire French workforce is 30 million. The entire British workforce is 30 million, right? We are creating that sort of jobs in 3 years, right? And this is not going to stop. As all of you know, there is still a shortage of workers for the financial services industry, the IT services industry, the transport sector. If you saw InfoAge's recent results, the Naukri hiring index is roaring through, right? We need way more formal sector people than we actually have. So formal sector job creation is going to sustain. The challenge will be informal jobs. The mazdoor, the unskilled mazdoor, unfortunately, has nowhere to go, right? He's not required to build the Bombay Coastal Road. He's not required to build the Bombay Metro. He's not required in the NHAI construction of roads. He's not required in factories. And this challenge of informal sector jobs being shed will continue. And the government's Jan Dhan Aadhaar mobile scheme of taxing you and me and taking our money and subsidizing, giving doles to those people, unfortunately will have to keep getting bigger. It's the same story around the world. We are not some exceptionally unfortunate country. But focusing on the positive, the formal sector job creation is massive. And therein lies our first colossal opportunity. India's services exports today are 0.25 trillion, right? Our services exports are $250 billion. The Western world's services economy is 15 trillion. The Western world services economy is 15 trillion. Even if 10% of that is outsourced to India, and that this will be a big focus of the trade deals that we are negotiating. We've already signed with Australia. We're negotiating with UK. We're negotiating with the European Union. These trade deals, a big part of it will be our services sector doing services work for the Western world. So the Western world has a $15 trillion services economy. Even if you assume 10%, 1.5 trillion comes to India. Our services exports go pentupled. They get pentupled in 4-5 years. If you assume that services exports pentupled in 10 years, even that will add 2 percentage points to GDP growth in our country, right? And obviously, colossal plays, as many of you know, in our portfolios we have TCS and L&T Technology Services. I'm sure there'll be other stocks we will consider as this colossal opportunity of exporting services plays out. This is not just IT services. This is HR, payroll, finance, audit, the entire Western services piece. Second area, right? China is, as anybody reading the newspaper can see, China shoots itself in the foot every week by abusing America, threatening India, flying fighter jets over Japan with missiles loaded and so on. As they continue doing that, naturally, a whole bunch of things that the Western world buys from China, they will relocate the sourcing of that. And right up on the list, right up on the priority list of where the West wants to rebuild their supply lines is medicines for justifiable reasons. India's API industry today is $10 billion. China's API industry today is more like $100 billion. Even if 20% of the Chinese industry moves, that's a trebling of our API industry. And I think that's, again, a 4 or 5 year story, a trebling of the API industry, right? How are we going to make money here? Right, you've seen alkylamines in our portfolio, you've seen GMM in our portfolio, and you obviously have Divi's in our consistent compounders portfolio. Companies which are utterly dominant in what they do and faced with a colossal structural opportunity as China shoots itself in the foot. And finally, the opportunity that we are a part of, the financialization of flows. Again, if you go back to that Economist cover story, you'll see the joining up of the country naturally will lead to more people choosing to save through financial services. This is not fiction. It's already happening. If you see the data from SEBI, RBI, IRDA, and you add it up, in the year ending March 2022, $85 billion of Indian domestic money moved into stock market related products, right? Mutual funds, direct equities, AIFs, PMS, insurance, $80-85 billion. So if you do $100 billion of domestic savings moving into the stock market over 10 years, that's $1 trillion of local inflows. India's household wealth is roughly 10 trillion. So even if we move $1 trillion in, that'll be still 10 trillion, 9 trillion still in physical assets, right? And there's a whole gamut of plays around it. Companies that you've heard from us for many, many years now. The Kings of Capital is a play on this dynamic, right? Now, that's the background. Now, what does this all mean for making money? Are we making money from this? Rakshit, over to you.
Thanks, Saurabh. Good evening, everyone. So on this slide, you see the outcome of fundamental progression of our consistent compounders portfolio over the last decade or so, broken into 3 equal parts. And there are some very interesting conclusions, I think, worth drawing from this slide. So the first and foremost, and the next click will bring more encircled. The first and foremost bit is, if you just see returns on capital employed for our portfolio versus that of Nifty 50 index. To begin with, on an absolute basis, 30 to 35% return on capital employed has been very consistently maintained by our portfolio companies over the last decade for every 3-year roll. More importantly, look at the gap between what our portfolio companies have delivered in terms of return on capital employed versus what Nifty 50 has delivered. There's a massive gap, and the gap is also wide even in the most recent 3-year period. The more interesting thing is when it comes to growth, right? So once return on capital employed means a lot of free cash flow has been generated, it needs to be reinvested to drive growth. And over the last few quarters, you have heard us talk about how in the more recent quarterly reported fundamentals, revenue growth rates of our portfolio companies have accelerated into the mid-20s for pretty much all these companies. And there is a massive market share gain behind this mid-20s revenue growth reported in the last 1, 2, 3 quarters on a 2-year, 3-year CAGR basis. And this market share gain is against both organized as well as the unorganized competitors. Right now, when it comes to this market share gain, we had highlighted this is happening because of 3 types of capital allocation decisions, which have seen massive acceleration in the last couple of years of difficult times for the broader external environment. Firstly, there are too many acquisitions. Secondly, there are too many tech investments, which have led to a complete business transformation for several companies. And finally, there are lots of companies which have doubled their capacities by putting in a lot of capex to prepare for future demand. Now, this has certainly led to higher growth in the more recent quarters for revenue. But when it comes to free cash flow and operating cash flow, you can see at the bottom right of this chart, the free cash flow and operating cash flow growth rates have moderated from the 20-25% that we used to see this portfolio report. The moderation has been down to 13% CFO CAGR for FY19 to 22 and 15% free cash flow CAGR for FY19 to 22. Now, I'm sure many of you would be keen to understand whether this is a cause of concern or not. And obviously, in the longer run, if free cash flow doesn't compound at a very healthy pace, then you should not expect share prices to compound at a healthy pace. Now, peeling off a couple of layers behind this free cash flow compounding and operating cash flow compounding, and hence looking at 2 aspects. So first of all, the kind of capital allocation decisions which have started driving market share gains and hence accelerated revenue growth in the more recent quarters. Right. As I said, first and foremost, acquisitions. Now, think about it. The list of companies in this portfolio in a normal year, they don't acquire businesses, right? Actually, these will be the last few companies who would do massive acquisitions to grow. They are typically organic growth companies. But in the last couple of years, Pidilite has acquired a stronger competitor, Araldite, Asian Paints has made a couple of acquisitions in home decor. Dr. Lal has acquired Suburban. ICICI Lombard acquired Bharti AXA. HDFC Life acquired Exide Life. All of this activity has led to free cash flows, obviously, being a little more muted in the last couple of years. And Divi's Lab has doubled its capex in the last 12 months. And companies such as Page Industries, Titan, Dr. Lal, they've had massive tech investments to build systems, processes, and superior technologies in order to transform their competitive capabilities. All of this has obviously led to FY22 free cash flow being a little more muted, which is why the growth rates are relatively lower. Secondly, particularly in the fourth quarter of FY22, which is the quarter ended March 2022, there are several companies which have seen inventory days go up. So the likes of, say, an Asian Paints or Page Industries, they've witnessed rise in inventory days predominantly because of three reasons. First of all, strategic reasons where because raw material costs were going up and availability of raw material was becoming incrementally difficult over the last 6 to 9 months, these companies have piled up on raw material, which provides them with an edge to continue with the supply of their products and services rather than face the challenges that the competitors are facing around unavailability of some of the raw materials. Secondly, there's increased production by, say, Page Industries quite nicely called it out, and that was, I guess, applicable to many other firms in our portfolio. Fast-moving goods have been produced at a higher rate in the last couple of months to provide for rising demand, which will reflect in growth rates over the next couple of quarters. Right. And then there's a third, a little bit of an optical effect, but that's a small one, where end of the year raw material prices are higher than average sales prices for the period, and hence inventory days optically look higher. But combine these two, there's massive investment that has gone onto working capital and capex that is leading to a significant acceleration in revenue growth, market share gains, and this will feed even more into the growth rates of FY23 and FY24. And hence, in conclusion, the basic principle of growth in free cash flow, growth in earnings, is that return on capital employed should be high and reinvestment rate should be high. A multiplication of ROC and reinvestment rate is the growth. That's simple mathematics, simple finance for you. ROC for this portfolio has been maintained and reinvestment rate has been accelerated. And we are looking forward to a huge acceleration in revenue growth as a result. Obviously, when reinvestment rate gets accelerated, then in the short term, free cash flow growth moderates, which is what we've seen in the most recently reported quarter. So I'll stop here. Saurabh, back to you for the next slide.
So folks, we'll now do the same exercise for Rising Giants, right? So this is a portfolio we launched on 16th August last year. CCP for the best part of 5 years, we've been looking after it and returns have been solid. Rising Giants is a newer portfolio. We launched this on 16th August last year. I think we're down some 17%, minus 17% return, right? The reason we don't lose sleep, we're not happy about the fact that it's down 17. We've got a lot of our own money invested in this. The reason we don't lose sleep about that is the fundamentals. So once again, just focusing on the fundamentals. So let's start with the ROCE piece, right? So if you look at those red circled areas, in the most recent period, ROCs, Rising Giants, remember, are mid-cap companies. Typical Rising Giants company market cap is around 30,000 crores. Typical consistent compounder market cap is more like 40 billion. So that's 2 lakh 40,000 crores. Rising Giants are 1/10. Rising Giants are 1/10 the size of the consistent compounders. ROCs here are 24% in the most recent period. And you can see they're incredibly stable. The ROCs were pretty similar 5 years ago or 10 years ago. And the superiority of our Rising Giants return on capital vis-a-vis the BSE 500 is also actually incredibly stable, right? 24 plays, 24 versus 17, 18. But what's remarkable is the growth in free cash flow here. So as Rakshit said, the CCP companies Pidilite, Berger. They've invested heavily. They've made acquisitions. Dr. Lal bought Suburban. Pidilite's bought lots of things, plus built new plants. Asian Paints has doubled capacity. The rising giants have also spent money, but because their expenditure the capex hasn't been so heavy, the free cash flow compounding is a stellar 39%, right? So free cash flow compounding, again, notice rising giants are pretty healthy throughout. So latest period, 39% free cash flow growth. Previous 3 years, 23%. But again, FY 13 to 16, rising giants grew free cash flows at 44%. Many of these companies were not listed then, right? So you might want to take that 44 with a pinch of salt. And then down to operating cash flow, again, solid numbers, 24. If you look at the free cash flow superiority of rising giants, it's huge. BSE 500 is growing free cash flows at 15%. The rising giants are growing free cash flows at 39%. And since the main driver of share prices, folks, the driver of share prices is not corporate profits. The driver of share prices is free cash flow, right? Finance 101 teaches us that the value of the company is the future free cash flows discounted. If you or I have invested in a portfolio where free cash flows are compounding at 39%, it stands to reason that we stay invested and make full use of the fact that there is good compounding ahead of us, right? So that's the rising giants portfolio, down 17% since we launched it. Little champs, it's been incredible, right? This small cap portfolio, soon it will be celebrating 3 years in August this year, and yet it's been a steady 30% compounder. Nobody thinks small cap is steady, but this company and this portfolio has been very steady in its compounding. Why has it been steady in its compounding? Once again, the story is good old fundamentals, right? Fundamentals. Let's look at little champs, right? So these are now rising giants for around 30,000 crores market cap. Little champs are more like 10,000 crores in market cap, right? This is the smallest of our sort of in terms of market cap. This is the smallest of our portfolios. We'll manage the best part of 900 crores here. So again, if you look at ROCE, the superiority of the little champs to BSE small cap in terms of ROCE is very stable. 23-24 playing, 23-24 versus 14-15%, right? We're consistently 7-8 percentage points superior to BSE small cap in terms of our fundamentals. That results because high ROC means you have more resources, you plow more back into the dhanda, you plow more resources back into the dhanda, it gives you superior free cash flow, 30% free cash flow compounding from the little champs through FY 19 to 22. You would have thought through COVID, through all this Russia disruption, small caps would get pulverized, and yet you're getting 29% free cash flow growth through this period, right? FY 16 to 19, it was more modest, tough period, demon, GST. But again, 13 to 16, solid growth in free cash flow. So those are the first three of our portfolios. Kings of Capital, we launched this in July 2020. Fundamentals are rock solid. Tej explained it in his webinar. I'll just repeat the same point again. Same point, 17% ROE in spite of this being lenders coming out of COVID. The lenders superiority to the bank Nifty on fundamentals is enormous. 17 playing 10. Similar profile to preceding periods, right? FY 16 to 19 as well. Our portfolio was superior on ROE. Where the difference has come through is because of the COVID unwind. Low quality lenders in the bank Nifty have also shown good PAT growth, right? So because low quality lenders have shown good PAT growth, the Kings of Capital have underperformed, and we'll discuss that in a minute. But in terms of the quality of the Kings of Capital, you can see the names, ROE, solid compounding in PAT. If a portfolio grows PAT at around 22%, book value per share at around 20%, you'd expect to see it give 20% compounding. And my reckoning is we will see that from Kings of Capital. Now, let's come to the slide that epitomizes our challenges in the last 12 months. Since inception, we've been all right. Last 12 months have been difficult. We haven't made money really in the last 12 months for you. It doesn't fill our heart with joy. But at the same time, if we try to make money every year, and we try to tell you that we will make money every year, and we zigged and zagged our portfolio to deal with macro developments, we will end up creating needless churn. So we're not happy about the fact that we haven't made money in our portfolios in the last 12 months, regardless of which portfolio you look at. We haven't made money in the last 12 months. But our view is this quality of portfolio, allied to India's positioning as a country, should hold up nicely in the years to come. And that's why we carry on doing what we have done for many years. Clean companies, well-run, high-quality franchises, sensible capital allocation, and the compounding in fundamentals that we have shown you. If we carry on doing that, you will make money. We hope it's sooner rather than later. Pramod, over to you.
Thanks, Saurabh. So to everybody, just to repeat, if you can put in your questions in the Q&A box. So Saurabh, I'll start off with the first section, the few questions, perhaps worth bunching them up. Specifically, I think people are asking, why do you think India will go the Japan way and not the US way? I think the Japan way you've explained. Why not the way the US went?
So the fundamentals sort of, if you boil it down to its essentials, Japan's success in the 70s owed itself to three things, right? It was a more efficient economy. It was a more efficient economy than America. It could make high quality products at lower cost than America could. Secondly, the economy through the 60s had invested in infrastructure, in research and development, in education systems, and therefore coming into 1970, Japan was a far more leaner, meaner, efficient country than it was, say, after the Second World War. And the third reason was the oil shock, in a way, catalyzed all of those trends, right? It was an efficient country, but hey, Americans through the 60s were having such a great time, the swinging 60s, that the Americans didn't care much for efficiency. The oil shock constrained America's spending power. It tightened household budgets, and suddenly American households said, you know what, I could do with a cheaper car, which is still reliable. I could do with a more energy efficient car. And by the way, I don't need clunky, large IBM machines. I need leaner, meaner electronic calculators for my business, right? So Japan was, as it is, a decent economy. The oil shock forced the Americans to take cognizance of that. I think a lot of that is true for our services sector. Our services sector, as I said, is what manufacturing was to Japan, services is to us. And I don't think you need us to tell you that the Indian IT services companies are the world's most efficient. They're also gigantic. Their TCS is the world's second largest. But from what we are seeing, the amount of work that's heading towards India from the Western world is colossal. It's not just IT work, finance, payroll, HR, audit, basically anything that does not involve a boardroom in London or New York or Paris. All of that work is coming towards us. And we did some market sizing for you, we reckon it's a $1.5 trillion opportunity that will flow through in the next 4 or 5 years. Even if it flows through in the next 10 years, it's colossal. And again, you can see the impact of that, right? Rapid job creation in the formal sector. Cities like Hyderabad, Bangalore, Pune, Mohali, Gurgaon, booming on the back of that. And I think this will sustain. And as I think Infosys, we don't have Infosys in our portfolio, but Infosys recently said, and that's validated with what we are hearing from our friends in the Western world, there is no shortage of demand. There is no downtick in demand. And I think this will become a 10-year story. I spent 2 weeks in America recently on work. And you can see that there is a insane labor shortage, right? They can't even find taxi drivers, let alone find people to man the finance function. They can't find hotel receptionists, let alone find HR professionals, right? The sheer shortage of labor in America. If America's labor short, Europe is 10x labor short, right? America at least has immigrants and a younger demographic. Europe doesn't have that. So the sheer shortage of skills and the high price of that skill for what is a non-core activity, right? For Wells Fargo, all said and done, for Wells Fargo, their finance function or their HR function is not going to be the critical driver of comparative advantage. And hence, by definition, it will end up in India. And that's what you'll see for a big size of our economy. We are an unusual developing country. We are a services-oriented country because people have stereotypical notions of what a developing country should be. These stereotypical notions are based on China and Japan. Not every developing country has to be manufacturing-oriented. We are a services-oriented country, and we are a superpower in services. Staying with that, our own financial services sector because of financialization of the country, because of that colossal amount of savings, financial savings pouring into the system, our financial services sector is 1/3 of the stock market. It's nearly 30% of GDP. It's a big part of our economy. It's also a very efficient financial services sector. Just to give you guys a sense of how efficient the Indian lending sector is vis-a-vis America. In America, the 10-year bond yield is 3.5%. US home loan, US mortgage rates are 5%, right? 150 bips premium to the 10-year bond yield. In India, the 10-year bond yield is 7%. Your HDFC Bank or Kotak Bank home loan is 7%, right? Our banking sector allows you and me to buy a house at the same borrowing rate as the government of India, basically. In America, they charge American households of 150 bips premium, right? Remember, the world's largest economy is charging households of 150 bips premium to take a home loan, right? It's a simple measure of how much more efficient our banking system is vis-a-vis what's been built in the Western world. Again, the whole use of technology to make banking more efficient. A whole bunch of services that are offered by Indian banks today. I told you about UPI, Google Pay. The way Indian banking system allows you to pay and function, a lot of it is not available in the Western world. So services, IT services, financial services, big chunks of our stock market, big chunks of our economy, very efficient. And in a way, quasi-linked to that, a quasi-services type sector, a sector which plays to our strengths is the API piece, the specialty chemicals piece, the pharma industry. Now, pharma, we're already the world's second largest pill producer. In the next 5 years, will unquestionably become the world's pharma factory. The reason we don't invest in too many pharma stocks is no comparative advantage there. But the API industry, the active pharmaceutical industry, active pharmaceutical ingredient industry, China rules the world. It produces 60-70% of the world's API. Its API industry is 10x our size. A lot of that will move to India. It can't move to Vietnam. It can't move to Bangladesh. India is the natural country for the API industry to move. Today, API in India is $10 billion. I think just basic mathematics suggests it will be many times that size over the next 4 or 5 years, right? And this is how you need to think about economies, not sort of casual chatter about hamara competitiveness index mein kya ranking hai. You have to think about economies like you think about countries. What can our country do where we are world class, where we are hyper competitive? We can do IT services. We've done it for 30 years. We built colossal companies. Those companies, something like TCS, potentially becomes a $1 trillion company in the next decade or so. All of us have seen the same story play out in banking and financial services. That sector naturally will get very big. And then the entire pharma API ecosystem, where our preferred place, API and the ecosystem, the specialty chemicals ecosystem, which supplies the API industry, a GMM Pfaudler and ceramic reactors, alkyl amines in aliphatic amines, right? And we sort of do a lot of checks on how competitive are we in this industry vis-a-vis the rest of the world, and we are world class. If you're world class in a world which is now struggling, right? Remember, if the world is booming, even the Western consumer is not price sensitive. When budgets start, when the consumer's wallet starts feeling the pinch, that's when the consumer says, "Boss, mere ko sasta chahiye." And when you need high quality, efficient products, efficient services, you will call the Indian.
So just taking that a bit forward, a few more specific questions around industries and sectors which are likely to benefit and why. So one is around the services sector. What percentage of services can be sort of outsourced or offshored or exported effectively as opposed to goods? A lot of the services economy is local economy. Secondly, IT services in particular, if the Federal Reserve goes ahead with the rate hikes, likely to take US into a recession, which will have some sort of a slowdown on IT spends as compared to the recent past. Won't that sort of curb the Indian IT services industry's growth as well? A couple of questions around manufacturing. I'll come to that after the services piece.
Sure. So let's focus on the services piece, right? What can be outsourced? I think that's where the last 10 years have been such an eye-opener. So let's just take it sequentially. Decade back, say 15 years ago, we got mobile, right? We got mobile and we realized that that you don't have to be located in one place. You can take your work with you on these little things. Roughly a decade back, we got SaaS, software as a service, became popular. You don't have to buy, you don't have to install Salesforce by calling in a systems integrator. You can install bite-sized chunks of software. And then we got cloud. We got cloud 5-6 years ago, right? Or 6-7 years ago. But what COVID has done is allied all of this to remote working. Because remote working is so much more acceptable now, as we go into a downturn, a Western CEO will say, I'm under pressure on my top line. I've got all these workers employed on my payroll in UK, in USA, in France, but they're working from home. Right? They're working from home, right? As you guys must have read Elon Musk sending a letter to his team saying, come to office or you're basically sacked, right? Those of you who haven't read the letter, just go up and look it up on social media. And today Tesla has announced that they're laying off, I think, 10% of their workforce, right? If Tesla is laying off 10% of its workforce, folks, you can be rest assured most Western companies are on the cusp of making big layoffs. As they make layoffs, why are they making layoffs? They're saying, I can see revenue pressure. And I've got this whole bunch of people sitting at home in the Western world. Why do I have them sitting at home? Why don't I just hand this over to the Indians, right? Because remote working has become so much more acceptable due to COVID, and because putting all your data on cloud with full security protection has become so easy in the last 4-5 years, Western companies are going to do exactly that. They're going to put their data, everything on the cloud, firewalled, and they're going to turn to a TCS or an Infosys and say, do this stuff from India, will you? I don't want the jhanjat. This is not part of my core competitive advantage. Anyway, I struggle to find talent in the Western world. I've struggled to find affordable people. You guys can do it in India. So I'll give you an example. If you see 9 months ago, I think it was Virgin Atlantic, which announced a deal with TCS. You can just Google it, Virgin Atlantic TCS, Google it in the newspapers. You'll see, barring the pilots and the air hostesses and the boardroom, pretty much everything else that Virgin Atlantic does is now been handed over to TCS. Not just IT services, entire operations, payroll, HR, finance, everything is now TCS. And this sort of outsourcing will become the norm as the downturn proceeds. Why will it become the norm? Because the catalyst will be cost pressure aayega. The Western company will feel the pinch on its operating margins. And COVID has validated that you can do all this work remotely. You don't need the staff in the office. So this was bound to come to India. We'll see a colossal boom here. The free trade agreements India is negotiating will have this as a big part of India's free trade, right? So just to put some numbers around it, we have a $3 trillion economy. Within that, 1.5 trillion is services. And within that 1.5 trillion, $250 billion, right? Within that 1.5 trillion of services, $250 billion is exports, right? Exports of services. This $250 billion, we believe, can easily become, this $250 billion of services exports can easily become 1.5, perhaps even 2 trillion in the next 5-6 years. As the Western world feels the pinch. You need the cost pressures on the West for them to outsource their entire office to India. They'll leave a few core functions in London, New York, Paris. Everything else will be shipped off to India. Your next point, the second question you'd asked was, Pramod, just remind me again.
So one was, of course, I think in some ways you answered it, because if US were to go into recession, will IT spends?
Yeah, so let's use a simple sort of what IT folks do, right? There's a bunch of IT work is run the company, and then the sort of next bit is grow the company, right? Now, obviously, growth-oriented spends will get curtailed, right? Naturally, if you're an American CEO, Jamie Dimon said, 2 days ago, hurricane coming. So I presume Jamie Dimon will say, grow the company spends ko kam karo. I presume he'll say to JP Morgan team, grow the company, kam karo, batten the hatches, prepare for the hurricane. But as they batten the hatches and prepare for the hurricane, and as they squeeze their cost base and they try to tighten their cost base, and Americans, credit to them, it's a brutally efficient country, right? If they see recession coming, as we've heard with Tesla, you'll hear about workforce ko lay off karo. It's brutal there. There's no sort of sentiment. Recession aa raha hai, boss logo ko nikalo building se, cost kam karo. As you see that, work will actually come to India, not grow the company spend, but American companies trying to economize on cost by sending stuff off to India. And it's a very sellable proposition to their shareholders that I'm the CEO here. I can see a recession coming. I need to get more done by outsourcing to India.
Right. So on the manufacturing piece, yes, API is a real opportunity, but does it really move the needle? $20 billion. I mean, Japan grew its manufacturing on the basis of large industries like automobiles and electronics. We still, in India's problem is the huge import bill from electronics. Do we see any opportunity, or we should watch
So look, I'm being conservative here. If you guys want to be aggressive, feel free. I mean, China makes $100 billion of this stuff. How much of that will come to us? I don't know. I was deliberately conservative saying, just assume that China loses a fifth of its market to us. If Xi Jinping continues in the current vein of every week abusing America, then maybe it won't be 20 billion opportunity. Maybe all 100 billion will come to us. The only challenge is we don't have that sort of processing capacity in India to make API. But on a more serious note, for a player like Divi's, this will catapult them to the next leg, right? Ironically, given the structural opportunity, it sort of amused us no end to see the Divi's stock price coming off as people said, "Arey guidance ही नहीं दिया, बताया नहीं कितना growth आएगा." Right? It's as if Murli Divi has to sit the analyst down and say, "Beta देखो, this is India's production, this is China's production, this is what can come to India." But on all seriousness, for a specialist like Divi's, who doesn't compete with Western companies, in the formulations market, Divi's doesn't compete in the formulations market. He's just a specialist in basically making stuff for the Western companies on an outsourced basis and making their APIs. For him, it's a life-changing opportunity, right? This company's market cap is $8 billion. Its top line, its bottom line, every aspect of Divi's could get transformed in the next decade or so as China loses some of its API industry naturally to us. There could be other companies as well. We keep looking at some of the other pharma companies that are good at making APIs, but nobody else in India has the scale of Divi's and the sort of the Rolodex that Divi's has with Pfizer, with Glaxo, with Mylan, that depth of connectivity we don't see any other Indian fine pharma company having, and which is why we carry on steadfastly being invested in Divi's.
Right. So in effect, it's APIs alone. I don't think we can hope too much from our ability to export electronics to the rest of the world. If we can make our own phones, I think that'll be a big deal. But I like this question, which we tend to ask management as well, which is, what can go wrong in your thesis? Why can't China bounce back? There's no China plus one story, or in general, India going the Japan way.
Yeah.
What's the risk to that?
So let's take those opportunities let me just beam the slide up, and let's take those opportunities one by one just to sort of understand whether China bouncing back is the core issue here or not. So the first piece, just to be clear about, is in the case of the services export stories, China is not a player. China is not a credible player in the services industry, right? I don't think any Western company is gonna ask the Chinese to deal with their cloud, right? So if you were to focus on this first opportunity, this is India's and India's only. No other country in the world, and the Economist cover story puts this beautifully. No other country in the world can provide you 5 million programmers a year. The only country where you can get 5 million IT services workers a year is India. So यहाँ पे तो this 1 point, the services export opportunity is ours and ours alone. China is not a relevant competitor here, and China could bounce back. It still wouldn't detract from this opportunity. Here, the trigger, as I'm saying, the trigger is the West needing to crunch costs, the West facing labor shortages, structural labor shortages, and in the face of the West saying we don't have enough IT workers, enough accountants, enough HR workers, Indians, you do it. I think this opportunity is ours to lose, honestly. And given the reputation that TCS has built, I doubt TCS will drop the ball on this one. This piece, if China bounces back and China suddenly says with America, we are best friends now, I'm sorry, that was a bad dream where we were abusing you every week. We don't want to take over Taiwan. We don't want to shoot Indian soldiers dead. We have no enmity with the rest of the world. Russia is not our best friend. Maybe this China plus one piece goes away. But somehow, given how far Xi Jinping has walked down this path, if Xi stays in power, I somehow doubt that he's going to retrace his steps. And as long as Xi is there, China plus one is alive and kicking. And everything that we are seeing from the American pharma companies and from Divi's Labs behavior suggests there's a ton of work coming towards the Indian API industry, right? But this piece, I agree, is dependent on Xi. If he somehow has a character transformation, China could save itself here. And the last piece is entirely ours, right? This is a domestic piece. We've spoken about it for years. This was why Marcellus was set up. Indian household wealth is roughly $10 trillion. 95% of it, the RBI has pointed out, 95% is physical assets, real estate and gold. Those physical assets don't compound at rates higher than inflation, which means on 95% of their wealth, Indian households don't actually create any real wealth. They don't create any real return. And naturally, those who are watching are saying, why should I do that? Why should I just condemn myself on my savings to earn 6, 7, 8%? I want to compound with the Indian economy. And that's triggering financialization at the rate of $100 billion a year. This has nothing to do with China. This is our own country. This is our Indian households financializing their wealth. So a big part of this, right? A big part of this opportunity is just India coming to terms with its own strengths, its own comparative advantages, and finding its place in the world. It happened with Japan in the 70s. It'll happen with us. It's a question of timing. Some of you might say it'll happen in 2030. Our reading of the world and our reading of India today is it'll happen in the next 10 years. It'll carry on happening in the 2030s. But as the Economist said, the Economist the cover story is India's moment. Right? This is our moment. It's arrived, and you can palpably see it in the way the economy is transforming itself.
So the next question was around the last point that you mentioned in terms of financialization. Obviously, we've seen the benefits as a PMS house ourselves, the mutual fund industry, and so on and so forth. But at the same time, this can also be attributed to sort of a fairly decent period for the stock markets, which triggered more flows into it. You've already seen, say, FIs pull out for 12 months now. The bust in the VC space means that the $80-odd billion of FDI we got largely through startup investing is also likely to go back. If the stock market continues to fall, obviously the sort of flows that we've seen from retail and domestic, which is compensated for the lack of FI flows, could also vanish. And who knows, with sustained inflation, the average Indian could go back to relying on real assets in real estate and gold as well. Given that we're still a largely capital-starved country, if these sources of capital disappear, or what are the chances of these sources of capital disappearing and putting a question mark on this recovery story?
So just to be clear, it's this story around financialization. It's not just a 4-5 year story. Back in 2004, the Indian 10-year bond yield, the government of India 10-year bond yield in 2004 was 17%. Today it's 7%, right? So basically, over the last 17, 18 years, we have gradually financialized. Yes, I agree with you. The pace has picked up over the last 7, 8 years, but the story has been pretty gradual. Now, if you look at the last 7, 8 years, it's always arguable. Did the financialization drive the stock market, or did the stock market drive financialization? Right? Which way the causality runs, we can argue. But here's a bunch of things that I've seen over the last 7, 8 years. Number of demat accounts have quadrupled. Right? And these demat accounts are not just wealthy people like the people on this call. A lot of these demat accounts are very ordinary working class people. So, for example, my yoga teacher opened a demat account 2 years ago. And he's seeing some losses, and I keep asking him, बंद कर दिया क्या trading, आपने loss आ गया क्या? And he says, नहीं, यहीं पे करते रहेंगे, सीख रहे हैं, आपकी किताबें पढ़ रहे हैं, सीख रहे हैं, right? And there are millions of Indians like my yoga teacher, who've over the last 8 years opened demat accounts. They've had their ups and downs. If you opened your demat account in 2014, basically when the BJP came to power, you would have seen, you would have got pounded in the year of demon. 2016, you would have got pounded badly. Then again, in 2018, you would have got hurt badly. Then obviously in the COVID crash of 2020, you would have got hurt badly. And if you joined the market in 2014, this is your fourth tough experience, right? It's not as if from 2014 to now it's been a bed of roses. From 2014 to now, we've had several 8-9 months pullback. I remember, Pramod, 2016, from Jan through to November, the market pulled back nonstop. It was a 25% retracement, 2016, right? It wasn't some sort of party, right? A lot of people write this stuff in the newspaper. This is the first time, you'll read the newspaper say, this is the first time Indians are facing a bear market, as if the last 10 years we were facing a structural bull market. And if you look at the demat accounts growth story, it basically coincides with the sort of the BJP coming to power, and it's continued 4x growth in demat accounts in the last 8 years or so. Similarly, bank accounts, right? Again, big part of the financialization industry is just bank accounts. Last 10 years, number of bank accounts have trebled, right? When the auto rickshaw driver tells you Google Pay pe aap pay kar sakte ho, basically he's telling you can pay him in his bank account. When the sabji wala tells you आप मेरे को गूगल पे में पे कर सकते हो, effectively he's telling you you can pay him in his bank account. That's got nothing to do with stock market, but it is financialization of wealth, and it's very powerful. Third layer, the rise of life insurance, the rise of health insurance, right? If you guys go to the IRDA website, you will find life insurers, whose names you've never heard of, right? Second rung, third rung life insurers whose names you've never heard of. Their premiums have grown in the last 6-7 years at 18-19%, right? And the final piece, right, the stock market, whether you look at mutual fund ka corpus or general stock market compounding, it's been decent. My reading of these sorts of transformations, it's a two-way street. You financialize the country a bit, that drops the cost of capital, makes the economy more efficient. The economy grows a little faster. That in turn creates a little bit more wealth. People financialize a little bit more, and you basically have an upward trend. Is it a straight line going up? No, it'll never be a straight line going up. There will be pullbacks, but it's a upward facing sawtooth pattern. It's an upward facing sawtooth pattern. You're broadly trending up. Obviously, you'll have pullbacks. If you have a year like 2016 where the market pulls back 20%, naturally, there will be a setback. And much like the month of May, right? If the market pulled back in May, you saw a pullback. But the overall structural trend, I think, is here to stay, and which broadly means by the time our careers are done, the 10-year bond yield in India will be very comparable to the 10-year bond yield in America.
Fair enough. So that's pretty much it on the macro. While I move to some of our Rakshit's favorite questions, before that, we might want to handle the question on financials. Why have Indian financials performed so poorly in the last 2 years? We're not talking about our financials. It's generally the bank Nifty itself has lagged the Nifty. And how do we see that going forward given rising interest rates?
Right. So think about it, right? When do people borrow from banks? People borrow from banks, or corporates rather than, when do corporates borrow from banks? Corporate borrow from banks when they can't borrow from other affordable sources of finance, right? Corporates borrow from banks when they can't borrow from other affordable sources of finance. And in the last couple of years, the Federal Reserve has made sure that money is basically free. By pushing the US 10-year bond yield basically towards zero, by pushing the US 10-year bond yield to zero, the Fed made a wholesale market money, financial market bonds very cheap. And that led to corporates saying, I don't want to borrow from the bank, I'll borrow from the bond market. And if you borrow from the bond market, then a Kotak Bank and an HDFC Bank, they have very strong CASA franchises and very, very low cost of funds, but they can't outcompete the bond market. As the Federal Reserve now tightens in order to calm inflation down in America, right? As the Federal Reserve basically pushes America into recession and calm inflation, the cost of money, the US 10-year bond yield will go up. It's already, I think, reached 3.5, 3.6%. As the US 10-year bond yield goes up, the cost of wholesale market money will rise. And you can already see the effect, right? You can see within 2 months, banking system credit growth is rising. So you'll get two effects on banks, right? A credit growth in the banking system will rise as corporates switch from the bond market to borrowing from banks. And the second is the better banks, the sorts of banks we invest in, the sorts of NBFCs we invest in, their assets will reprice faster than their liabilities, right? So as Tej explained in the Kings of Capital call, a bank like Kotak's loans, its assets will price upwards as interest rates go up. Kotak's liabilities are heavily CASA, current and savings account. The repricing of CASA is much slower, and hence Kotak will get a NIM jump. So you get a triple play. You get a triple play. You get the improvement in credit offtake, the improvement in NIMs, and solid credit quality. And that's why for well-run banks, a rising rate cycle is a good place to be. Which is why, without being what should I say, cryptic about it, which is why HDFC Bank and Kotak Bank have started moving finally after 2 tough years. But if the wholesale market gives you super cheap money, then in a way the banks become redundant. Thankfully, the wholesale market can't perpetually give you super cheap money. At some point, the Fed has to pull the punch bowl away. The party stops in America, and as America goes into basically detox mode, cost of money rises, and corporates in our country turn to our banks and say, I want to borrow. And the banks then jack up their NIMs as well. Credit quality, I'm sure, will stay strong. And that's why I reckon Kings of Capital should have a couple of solid years ahead of it.
Thanks, Saurabh. So, Rakshit, moving to you, I think somebody's asked a question which perhaps relates to the sort of holiday period that you talked about. Effectively, they're saying you clearly have demonstrated enough data points which suggest that the fundamentals have been strong for your companies. There's no doubt about it. And it is also understandable that in the short run, share prices might diverge from fundamentals. But have you seen a period this long where so many stocks in the same portfolio demonstrate this sort of divergence? Is it because this time around, there's also a valuation angle to it? Where valuation of these stocks had risen because of fundamentals, and therefore it's taking a little bit of a breather.
Yeah, sure. So first and foremost, have we seen this happen in the past? Yes, this has happened once every 5 or 6 years, and once in every 5 market crashes typically. So that's the frequency. Out of 4 market crashes or 5 market crashes, once you will see what we've seen in the past 6 months, and 3 or 4 times you'll see what we saw during the COVID crash, which is incredible resilience. The longest that we've seen underperformance in the down market for our portfolio companies was during 2001-3. It was a long 2.5-year period. Just to highlight, the likes of, say, an HDFC Bank, their profit after tax compounded at a rate of 48% CAGR over 3 years, FY 2000 to FY 2003. However, HDFC Bank's share price went downwards during those 3-year periods, right, despite a 48% CAGR in profits. And it wasn't just HDFC Bank, the entire consumption pack saw a massive drawdown, because 2002, FY02 or FY03, and I think in both the years, there was a massive negative growth, as in decline, in the consumption part of India's GDP, right? And a consumption part is the largest part of India's GDP. I think in one of those 2 years, it was a minus 18%. Right, there were a couple of back-to-back droughts, etc. So it wasn't because of non-fundamental factors like the FII outflow, etc. Well, that could have been part of the reason when there was the 9/11 or the tech bubble bust, etc. But there were several sort of India-specific economic factors which led to the holiday period being that long at that time. But even at that time, when PE multiples, quote unquote, PE multiples, they compressed by 30-40%. because obviously if you can see HDFC Bank's PAT CAGR going in a different direction compared to the share price, the PE multiple is massively compressing, and that happened to Nestle, and Asian Paints, a Pidilite, every such stock. The recovery after the holiday period was over covered up for it. PE multiples came back because the share price progression after the holiday period was over was far greater than the fundamental progression thereafter. Now, had it been a PE multiple compression because of overvaluation at the start of the holiday period, then after the end of the holiday period, share price would not have rallied to catch up with those PE multiples, right? So Saurabh is projecting that chart, and yes, so for Asian Paints, there's been a 12 to 18 month long holiday period, thrice over the last 1 decade itself. Once it was during 2010-11, and then 2015, then 2018. Likewise for every other stock as well. I think this slides pack has Pidilite, Dr. Lal, HDFC Bank, so on and so forth, right? Now, separately coming to, and Saurabh, I think the traffic light slide is there in this. Separately, coming to the question of what is our view on valuations? Has the share price fall of the last 6-9 months in various cases been because of overvaluation? So this is the chart which summarizes it in one single exhibit, which is that when you look at the price to free cash flow over the last 6-7 years, the price to free cash flow till FY21 end had not gone anywhere for most of these companies. In fact, for many of them where you see a green light, the price to free cash flow has gone southwards. Now, why is this? This is largely because although earnings growth of these companies lagged behind their share price growth, and hence the PE multiple went up, the free cash flow compounding over the last 5 years, 10 years, 15 years, first of all, has been far ahead of earnings growth by 6-7 percentage points on CAGR basis, and hence price to free cash flow has not expanded at all, despite earnings growth expanding. And more importantly, fundamentals have progressed perfectly in line with the share prices, and fundamentals have fully supported the share prices. So that's the first piece of relative share price movement and relative to their own historical multiples, right? There's no expansion that we saw till 12 months ago, and hence whatever compression we've seen in the last 12 months should have a catch up to it. Secondly, when you compare it relative to Nifty 50, let's say, right? So the entire gap between our stocks' long-term share price return and Nifty 50's return is due to the gap between our portfolio's free cash flow compounding growth rate and Nifty 50's free cash flow compounding growth rate, right? So in an earlier slide where we were talking about consistent compounders is free cash flow compounding for the last 3 years and 3 years prior to that, and then the 3 years prior to that, you would have noticed the free cash flow compounding of our portfolio was always 8 to 10% ahead of the free cash flow compounding of Nifty 50, right? So there you see FY13 to 16, 29 versus 20, FY16 to 19, 19 versus 11. It's this 8, 9, 10 percentage point gap between the rates at which free cash flows have compounded and the rates at which hence fundamentals of compounding, which has defined the gap between share price compounding of these companies, which has been sort of mid-20s versus Nifty 50 over the same periods, which has been around, say, low teens, right? So there again, relative to Nifty 50, the outperformance over the longer term has been fully justified by fundamentals. And hence, over the last 12 months, the underperformance is not because of a reversion to mean, which was not supported by fundamentals. There's no reversion to mean here. In fact, on the contrary, because the outperformance historically has been fully supported by fundamental outperformance, whatever has happened in the last 12 months as underperformance, despite fundamentals matching up with Nifty 50, will have a catch up to it. And again, remember, the compression in free cash flow compounding that you see over FY19 to 22 to 13 to 15%, right, for our portfolio companies versus 15-16% for Nifty 50, that's got an optical effect from accelerated capex which has happened in our portfolio that has not happened of the same degree in Nifty 50, and the outcome of that is going to be a wider gap between fundamental rate of compounding over the next 3 years between our portfolio companies and Nifty 50. So there is going to be a catch up because the last 12 months of performance was not a valuation driven compression. And finally, I think on absolute valuation basis rather than relative, if you pencil in the longevity of greatness that these companies exhibit, and we believe they will exhibit in future, the moment you pencil that in, the fair value, the intrinsic value, is far higher than the share prices that prevailed 6 months ago or 12 months ago. Forget about just the share prices that are prevailing today.
So I'm just addressing the biggest questions people have, which is some of the, at least specifically Asian Paints and Dr. Lal Path Labs both being subject to competitive intensity with some dramatic announcements by some new entrants. How do we give ourselves the comfort that all will be okay?
Right. So first and foremost, and we have to talk about fundamentals separately for the two because they're two different industries. So for Asian Paints, think about it very simply, practically, that what matters in this industry to win market share is the ability to provide return on capital to channel partners, where the channel partners do not make margins and their return on capital is only through inventory turns. This is a voluminous product. Paint is a very voluminous product. Asian Paints has created an industry structure over the last several decades, which has left no margin for the paint dealer on the high street. There is no wholesaler or distributor involved, right? And the only way that a dealer would be willing to repeatedly stock a paint company's products would be if the paint company provides consistent high inventory turns. And the quantification of that is delivery within 3 to 4 hours of an order being placed by the dealer with the paint company, right? That's the gold standard that Asian Paints has set. If you beat that, you can certainly win market share. If you don't beat that, then there have been many companies which have tried and they've failed. Now, someone like, say, a large cement company which announces a 10,000 crore capex, why can't they so easily beat that? At this point, we believe that first and foremost, they'll have to bleed a lot. They'll have to bleed a lot if they run supply chains via distributors and wholesalers and try to match what Asian Paints is doing, right? Because Asian Paints supplies to 1.5 lakh dealers directly, and no other cement company or any other company in any other industry supplies to 1.5 lakh touch points on the high street directly 3 times in a day, right? So that's one. Secondly, even if you're willing to bleed and give 10% margin to the wholesaler or the distributor because you want to put your foot through the door and get a large market share and not make money in the short term, even if that was the case, that I have a bigger balance sheet, I'm willing to burn money for some time, even then you need demand forecasting in order to provide 3 to 4 hour delivery times to a dealer. If you don't have demand forecasting, no matter how much money you throw at the channel won't make return on capital, right? And in order to do demand forecasting, you need years and years of data to begin with, tech investments, and then an ability to forecast demand and set up supply chains which can cater to that demand. That can't be built over a short period of time. Forget about say 1 year, 2 year, and hence I think there's a lot more to the strength of the competitive advantage that needs to be appreciated here. That's on Asian Paints. Separately, some of you, I was reading the Q&A, are asking about crude oil prices. So we did a webinar a couple of months ago where we quantified that. Asian Paints' gross margin has been at around 43-44%, whether crude was at $40, $80, $120, or $140, right? Why is this the case? Because this company is playing a volume game. They do not want to retain the benefit of falling crude oil prices, and they want to gain volume market share when crude oil prices are going up, because just like what they've done in the last 12 months, they limit the price hikes in order to suffocate competition more. Because for an Asian Paints, operating efficiencies incrementally provide for margin protection in a rising crude environment. That helps them limit the degree of price increases. So they took only 15-17% price increases in the December quarter, and again a relatively smaller amount in the March quarter. And those price increases have not been enough for competition to sustain their profitability, and hence Asian Paints has gained massive market share. And this is the chart. Long-term gross margin, regardless of what the crude is doing, has been pretty steady, right? So whether it be about crude oil price or competition, we're actually very confident of Asian Paints' prospects to compound their free cash flows in the longer run. So Saurabh has encircled the gross margin bold line, regardless of what the dotted line, the crude oil price, is doing, right? So that's on Asian Paints. Separately on Dr. Lal PathLabs, let me just summarize it like this. It's not just the price that determines what a patient, what a customer of Dr. Lal chooses between two companies, because what matters a lot more is the service that the customer gets, right? And service is difficult to deliver. Service means turnaround time between sample collection and report generation. Service means integration into the medical fraternity, where a doctor gets the service of timely reports so that the treatment for the patient can start, so on and so forth, right? In the entire sort of cost expenditure of a patient, where you have to pay on the treatment cost, medication, doctor consultancy, maybe even hospital care, 100 rupee, 200 rupees saving on the menu card of a particular test is not something that matters much, right, in terms of defining market shares. Now, having said that, Dr. Lal PathLabs also does promotional offers whenever they enter a new residential society or a new geography or a new city. And we've seen that time and again. This is not something that only a Dr. Lal or a Tata 1mg or a PharmEasy is doing. Everybody in the industry historically has done promotional sort of offerings of very low, very cheap prices, just to get the ball rolling in a new area, in a new geography. This is not unusual. And those low price offerings are never sustainable, because obviously the cost of running an operation and scaling it up are way higher than those promotional offering price points, right? Hence, I think even on Dr. Lal, for those of you who are a client of ours, and if the person asking the question is a client, you would have seen what we've done to the portfolio to benefit from this situation. And rather than getting worried about share price fall, in fact, we did a lot more work fundamentally at the ground level to get convinced about sustainability of high quality compounding of this stock in future.
Yeah, that brings to me the last question about our portfolio rebalancing. I guess, Rakshit, what you're alluding to is doing exactly that. If you could just throw some light about how do we go about benefiting from such situations, effectively the portfolio rebalancing question.
Yeah. So look, first and foremost, we don't sit on cash waiting for a market crash, right, or a portfolio drawdown, because more often than not, there's more resilience demonstrated in a crash of this portfolio, and hence sitting on cash doesn't make sense. What we do is we stay invested at all points of time and compound with the fundamentals whenever there is a window of opportunity to benefit from dislocation in share prices. And dislocation in share prices can happen both ways. One stock rallies far ahead of the rest of the portfolio, or one stock falls far more than the rest of the portfolio. Whenever such dislocations emerge, it's an opportunity to benefit from it, because if that dislocation is not backed by fundamental dislocation, then there will be a mean reversion, right? This is where I think the valuation one-on-one matters. If Dr. Lal PathLabs or Asian Paints or some other companies' share price fall is not commensurate with fundamental deterioration in the franchise, then there will be a mean reversion in the share price. And if you try to benefit from it, you will be rewarded. We did exactly this 2 years ago when we trebled on Bajaj Finance's exposure after Bajaj Finance fell by 65% during the COVID crash, and nothing else had fallen much. We've done something very similar over the last month in the case of Dr. Lal PathLabs, where we've tried to benefit from this opportunity, and which, if you're a client, you would have seen it in your portfolio.
Great. That's pretty much it in terms of the questions. Thank you so much, Saurabh and Rakshit, and thanks to everybody for dialing in. We hope to come back to you soon with another webinar with another of our fund managers. Thank you very much.
Thank you very much. Bye for now. Have a good weekend.
Thank you. Bye.